Good day, everybody, and thank you for joining us today, our Prescient Investments Equities webinar. My name is Murray Anderson. Joining me today on the panel is Bastian, our CIO, and Seeiso, our Head of Equities. Welcome, gentlemen.
Thanks.
Thanks, Murray.
Bastian, we've done a couple of webinars thus far, and as per usual, we need to start with a global view, global macro view, that is specifically. Maybe we'll address, as we've did, a little bit of a view on 2023. We need to look at what played out globally, because that drove equity performance essentially. And then importantly, look forward to 2024. There's a lot on the horizon. We need to consider not only for portfolio construction, but also just globally how we all react at a portfolio level when constructing client portfolios. So obviously lots to think about. So Bastian, without further ado, over to you. What about this global backdrop?
Thanks, Murray, and thanks everybody for joining. Murray, I'd start with 2023. So obviously we had a year with a lot of downside surprises on inflation, which was very good, and then upside surprises on it, basically the global economy, which was also good. And I guess the really boost to the whole story was at the end of the year when the Fed kind of indicated a little bit of a pivot. So that was very positive, kind of like similar to what we expect for this year. So key drivers, once again, US growth, where we once again expect an upside surprise, to be honest. And then also the inflation scenario, where we once again expect a downside surprise. But then also like what is going to happen to the Fed's reaction, because they indicated now that there will be some cuts. So let's see if they come through, and when they come through, that will be crucial. So we'll once again have to monitor global growth, global inflation, and what the Fed is going to do. But then obviously on the back of all of that, we have to be wary of all the geopolitical risks which are out there as well.
So this geopolitical environment, as you said, there's a lot to consider. I guess the main driver being what happens to global growth, which is important for earnings, which obviously is important for equity investors. And that's particularly what we'll be focusing on today, is where do equity markets go globally. So I guess the growth story, but importantly, you spoke about rates and the potential pivot and cuts, as we would all hope that happen at some point this year. Let's dig into a little bit of all of that, and then as well as the geopolitics, which you mentioned.
Sure, I'll start with global growth. And if we say global growth, we often focus on the US. There's a reason for that, though. The US is really like the engine room of the global economy. And we can statistically measure and test that the US economy has the highest degree of predictive power on what other economic variables or other asset classes do. So yes, we focus a lot on the US, but there's actually a reason for that. So if we look into the US economy a little bit more detailed, we'll see that the Prescient Economic Indicator, our own in-house nowcasting tool, once again suggests that there will be an upside surprise in US growth. Okay, so let's look into what the Prescient Economic Indicator suggests and drill a little bit into the details thereof. So before I start, just a quick explanation on what we can see on the screen. Present Economic Indicator, that's this line here. We're going back all the way until the early 40s. But then what does really enter the system? So what we're doing here is we're creating a nowcasting based on a lot of economic time series, namely like it's stuff like gross private domestic investments, net exports or imports, sentiment, GDP itself, financial conditions, gross domestic income, personal consumption, expenditure, etc., etc. I could go on for a long time. But then most importantly, within these time series, there's a lot of sub-time series which enter the system. This is just an example of what we observe within the labor market. So we can take this way further, but in total it's more than 130 time series, which we track in real time to understand where the US economy is in real time. So where is it? I'm going to skip through some of these regressions, which just basically measure that there's a lot of statistical significance behind our indicator and its explanatory power on US GDP. So we'll look at this chart where we can see basically real GDP in the dark blue and then our estimate in the light green. And if we look at the two time series through time, we can see that there's a quite good tracking. It's not perfect, but it's quite accurate. And the big benefit becomes obvious when we zoom in, because once we zoom in, you can see on the very right-hand side of the chart that the Prescient Economic Indicator keeps on ticking every single day, while GDP is obviously just released a quarter, and it's also released with a quite big lag. So what does all of this tell us about the US economy? If you look at where the zero line sits, you can see that for the last year, we never really saw this deep recession. We never really saw that there would be a hard or a soft landing. We always said there's no landing. And that's what played out last year. But let's not focus on the past, let's focus on the future. So for this year, we will say that once again, as we speak, the US economy is showing quite strong growth. We can track it in real time at 2.5%, which is quite good. And with that, once again, we will say no recession, no hard landing, no soft landing for now. Obviously can change. We change that positioning as soon as the data change. But right now, that's what we observe. And if you just think about what we've seen over the last couple of weeks, strong upside surprise on US payrolls, strong upside surprise on US GDP. And with that, we actually expect the US economy to keep on going.
Thanks, Bastian. So from a geopolitical perspective, there's a lot going on, as we've mentioned. There's significant elections coming up globally this year. We've got war in the Middle East. We've got the Red Sea issues, which are affecting potential inflation around the world again. Yet what you've shown is that the US market continues to power ahead. I mean, this is quite surprising, and importantly, what we're expecting now is a no landing, when last year there was maybe a recession coming along the line which would affect equity markets. So how do you see this playing out in the US equity market again this year?
Yeah, it's a good point, Murray, especially if we consider that last year the US was an outperforming market, so strongest equity market. I guess this year will be potentially different. So we have a more cautious stance on US equities than on other equities, and just generally a very cautious stance on US equities. You mentioned geopolitical risks, so they play a role in there. So we do track those risks by looking at different economic indicators, like, for example, sentiment indicators, consumer confidence, business confidence, but also forward-looking investor confidence. We look at public sentiment. We can look at areas which are directly impacted by geopolitical risks, like, for example, the oil price or profit margins. So we carry like a lot of economic risks or geopolitical risks in our indicator set, but we don't directly take a view on what's going to happen because it's hard to predict. But so, no, you mentioned the US market strong again this year, not really. So we actually expect the US market to underperform, not based on the strong US economy. That itself would lead itself to assuming that the US economy is outperforming, but there are other headwinds this year. Okay, so let's start by looking into US equities a bit more detailed. As said, strong negative stance. So we do actually take a cautious positioning there because we are worried about the valuation headwinds. And if we contrast it against other markets, you can see on the screen that especially in SA, we actually do see way more value, but we're going to get there just now. Before we go there, just a quick glimpse into why we are negative on US equities. And you can see right at the top of the chart the valuation metric. Valuation points to minus 0.87, so that's how we score it. We score all of these indicators on a metric between -1 and +1, so minus 0.87 is just telling us that the market is as expensive as it gets. You can see the other indicators we also use, economics, financial conditions, and sentiment. There's not a lot of support from these either. I mentioned that on the economic side, we do have tailwinds from a stronger US economy, but we also have some headwinds which we have to mention in this instance. For example, shrinking profit margins, still also stronger dollar. So there are headwinds coming from an economic point of view. Financial conditions also negative, way too tight monetary policy for what the market can stomach over the long term, and that's obviously hurting corporates eventually, and that will hurt equity valuation. Then on a sentiment point of view, we do see a lot of negative surveys in the manufacturing sector in the States, but then we also see investor sentiment being quite complacent. So that means that we have volatility indices at all-time lows, meaning there's a lot of complacency, not a lot of pricing for risks, and that on the back of very stretched valuations is something which should be worrying us. So if we just go one step further and look into the valuation bucket and see what we're measuring there, you can see that we're using the usual ratios, price to earnings, price to book, price to sales, but then also the relative earnings yield, which is the PE ratio basically of the US market against other developed markets. And on any valuation metric, US equities do actually look expensive.
Thanks, Bastian. That's very interesting looking at those valuation metrics. So from a US perspective, we pretty have a negative outlook on US. But last year we saw a dispersion of global equity market returns, it was quite interesting to see some markets performing quite well, others not so well. Seeiso, maybe do you want to comment on that?
Yeah, certainly. I think if you look at the global landscape for equity returns, I think the biggest dispersion has certainly been between global and emerging markets. So I think both were up last year, had a positive year, but developed markets much so, primarily driven by the US, which was primarily driven by the tech sector. But if you look at emerging markets, they're primarily, I think, a quarter of that index is China, which really struggled, and we know that because of the ongoing growth concerns there, sentiment and the property sector. So yeah, quite a big dispersion in terms of relative performance across the global indices.
Thanks very much. Bastian, so maybe just to close out on the macro picture, we've again stated negative in US, but let's bring it home to South Africa. What's our view on the domestic equity markets?
Yeah, slightly more positive, mostly driven by the valuation story. So we have similar headwinds like in the US. We also have not expensive valuations. We also have macroeconomic headwinds. We have a lot of financial conditions being too tight, and we have a sentiment which is generally not supportive, especially if you look at consumer or business sentiment. But the big advantage we have in SA is that our equity market is cheap. Okay, so we'll start again with this screen to just basically compare the different equity markets. Just generally, you see most of our equity indicators are more on the left-hand side, so it's slightly more cautious stance, but there is one good opportunity this year, and we really see that in South Africa. So you can see that here. I'm just going to bring up the states first to just reiterate that we are basically having a lot of headwinds, mostly driven by valuations. Clothing that now going back into South Africa and just switch it over, you can see that here the valuation metric goes into the completely opposite direction. You can see we've got more economic headwinds here than in the States. We suffer equally from tight financial conditions. From a sentiment point of view, we're actually slightly more optimistic. That might sound counterintuitive, but what we're meaning here is that a lot of negative news is actually in the price for emerging markets. Well, that's certainly not the case for the developed markets. And then obviously the driving force here, the valuation factor. So if we just drill into that one step further to analyze what is driving our valuation score, same metrics as we applied to the US, price to earnings, price to book, price to sales, and then the yield against other, in this instance, emerging markets. But what you can see here, everything dark blue. So there's obviously a lot of the metrics just showing us that there's deep, deep value. So the room here is quite clear for a surprise for South African equities to outperform other equity markets, and that's something which we would be prepared for this year.
Thanks, Bastian. So, I mean, it's good to see that there's sort of upside potential from a South African equities perspective. So this is an important part for me to bring you in again, because from an equity construction process at Prescient, please share with the audience how we go about that portfolio construction given our investment process.
Yeah, definitely. And thanks, Mari. I think, so Prescient, we obviously quite systematic in what we do. So again, driven by science, sort of doing the groundwork, getting the numbers ready, and basing our analysis on empirical evidence. And with that in mind, we literally transpose that to our equity process, which is a bit of a difficult thing to do, given that equities are usually based on so much feel, and biases can creep into equity processes. But we try and eliminate that completely from our process, and we are more so concerned with making sure that our investors, regardless of whatever situation, get the full exposure of the equity markets. So empirically, we know that equity markets outperform most of the other asset classes, particularly on just an absolute return basis. So the worst thing we can do is deprive equity investors of that. So that's the first thing. Make sure that we have clean access to beta, just simplistically the equity market. And then we have quite a convoluted process, well, not convoluted, but quite a complicated process that just aims to ensure that we give a little bit, but consistently more than just what the equity market does. And that's this whole portable alpha story. And our regular viewers will know all about the portable alpha story. But essentially, that's what ensures, or that's how we built into our portfolio construction process the certainty of equity market performance, plus a little bit of additional outperformance via this portable alpha process.
See, so we'll come back to portable alpha, but I think there are two important components to this: is not only domestic equities, but also from an international equity portfolio construction.
Correct.
So covering both domestic and global equities.
Correct.
Maybe you want to talk to that, and in the context of that, talk about the global portable alpha component that you just mentioned.
No, 100%. And I think, being a South African-based investor, we obviously want to offer, when we say we offer equities across multiple jurisdictions, across multiple regions, and our portfolio construction process is quite suited to that because we first and foremost can offer wide diversification across developed markets, across emerging markets through our global offerings, while employing this capability. And we can obviously do it locally as well, but I think the key thing is being able to offer that diversified exposure in a global perspective as a South African manager is quite important.
So I guess the main point is considering our clients' requirements. There may be, let's just talk domestic equities. We can go to All-Share Index, SWIX, Cap SWIX, and we can offer all of these with this enhanced component being the portable alpha to give you that outperformance, which is a really unique opportunity set. And then obviously, again, on an international perspective, you can do the same on both developed and emerging market equities. So this is quite unique for a South African manager to be able to offer the full extent of global equities with a very strong portable alpha process. So maybe now dip into the portable alpha component and why that's unique to us. The way we do it being unique.
100%. And before I go into the portable alpha, there's actually, I think, an important point to make there regarding our offerings from a beta perspective. So pretty well thought out in the sense that, like you said, developed market, all country, emerging markets. So we tried to have our product offering in such a way that we can offer this portable alpha strategy across essentially any beta that a client would desire. So for instance, using as an example the all country. So the all country index is essentially developed market equities and emerging market equities with a certain ratio, I think about 90 to 10% at the current moment. By combining our developed market equity fund and our emerging market equity fund in those proportions, you essentially get to the all country index. And same thing locally. So locally, if you are simply looking to, let's say, get the same equity exposure as the rest of the market, that is a very specific combination of the available indices, and we're able to extract that and offer that as well as the individual indices underpinned by the portable alpha strategy.
Thanks, Seeiso. Now let's dig into the portable alpha process.
Yes, happy to do that. And this is where it gets a bit, we need to start talking more fixed income side and more cash and money market lingo. Essentially, because what we do is we've now sorted out the equity component. Our investors will get access to whatever equity beta they want, but in order to generate that additional return, active return, we do that in a completely different asset class, and that is the cash and money market space. And we have sophisticated and sort of robust processes to ensure that we can deliver outperformance, or we're best positioned to deliver outperformance in that space. Okay, so the reason we have to delve into the cash short-term fixed income space is because that is essentially our alpha engine. So we have our beta engine here, which is essentially equity market performance. So our investors get that regardless of what happens. But our alpha engine is really driven by the dynamics within sort of the cash and fixed income space. And that is because we use those assets to generate a additional return. So we might, for instance, put some cash in margin, which earns a 1.5% yield, put some cash in credit yielding assets that gives us about 2.85, and then some term assets for the rest. And all of that will cost us a certain amount to be able to do that. And whatever is left over is then this additional piece that we have on top of the equity market performance. So although investors still get the full benefit of investing in equity markets, they also get this additional benefit in that our portfolio construction includes these cash and money market assets to give this additional piece of return.
Thanks, Seeiso. So just looking at that process chart that you showed us, effectively on the right-hand side, client is getting an equity portfolio or the selected beta component, be that the index. And what you're saying is the portable alpha component is the alpha generator on top of that.
100%.
And obviously there's a process to get into that. What does that look like at the moment?
Yeah, so that process is actually crucial to delivering on our clients' objectives, and it needs to be absolutely robust and have risk management at the center of it. So we have a universe of assets that we can use, and we have a robust optimizer that we pump these assets into, and what comes out is essentially the best risk-adjusted high-yielding portfolio to deliver that additional performance. Okay, so the great thing about this portable alpha strategy and extracting alpha in the cash space is that there's a high certainty of a high degree of certainty in being able to achieve this, and because we're working with fixed income instruments essentially. So if you look at this, the portfolio that comes out of that robust process is currently giving us a yield of just about 10.2%, with virtually no duration whatsoever, so no risk. And then that translates to an expected return in the cash income space of 10.2. That costs us around 9% to get there. And overall, what this means for our end investor is that they stand to get over 1.2% above whatever the equity market does, simply because we employ this portable alpha strategy. So, and if you look at some of the metrics, the usual metrics like tracking error, is virtually no tracking error, about 70 basis points tracking error relative to whatever benchmark index of their choice, and a really high information ratio. So that's essentially additional return per unit of risk. You can see that is a number that is greater than 1, which means we're getting more in additional return than we are taking in unit of risk.
Thanks, Seeiso. So I think the important component here as well is to consider the fact that investors aren't just getting beta. They're not just getting an index return. You're getting an index plus portable alpha, which give you this additional return.
100%. And we are often misconstrued with passive investing, which of course we know has its own flaws, but we are far from passive. This is actually a very actively managed portfolio, just actively managed in an asset class that is relatively low risk, and an asset class that only adds a certain portion to an already given beta, an already given base of return, which is the equity market.
Okay, great. Seeiso, so I know that this equity process is built into our multi-asset portfolios and other portfolios we manage on behalf of clients where there's a multi-asset component, but how do our clients access your equity process and funds?
Okay, yeah, so we've tried to make it as easy as possible to access this investment philosophy. So we have various funds across literally any type of investor, retail, institutional, pooled, segregated. We have unit trusts that are benchmarked to essentially most of the major equity indices, and are running this exact process just on top of that, and that goes across locally and globally.
Thanks, Seeiso. And importantly, much in line with the Prescient Investment Management philosophy of pricing these products appropriately.
The great thing is that we are priced quite competitively, and I think that's part of that is because of the nature of these products. You're getting essentially equity market performance in quite a passive manner, but you're getting actively managed fixed income component with that. So you're getting it at around 30 basis points, which is much closer to a passive fee than a full-on active equity manager.
Thanks, Seeiso. Folks, we've come to the end of that, so maybe if I could just summarize from an equity perspective, both local and international equity exposure can be generated out of this process that you're managing. Strong portable alpha capability, proven track record, and importantly at a well-priced point for not only retail but our institutional investors, which we know over time plays an important part of the ultimate return that you get from a portfolio, given that it's priced appropriately. So thanks, gentlemen, for your input today. Always appreciate you sharing your insights. Thank you to our people on the line. It's always good to have people dial into our webinar, and we'll cut for questions. So we covered a lot in the session, and there was one particular point that a question related to the solution process. I think, and it goes along the line critically. How does this fit into a client's portfolio? So the portfolio construction process, and where would you fit the Prescient equity solutions into a portfolio?
Okay, yeah, that's an excellent question, and I think one that requires some clarity. So these portfolios are meant to be building block portfolios. So we are targeting specific beta, and I know it's not particularly the most favorable thing to target. Managers want absolute return, but what we are offering is a relative return to a specific benchmark. So for that purpose, they are designed to be building blocks and to integrate into part of a bigger equity allocation. So they're very style agnostic in the sense that you're just getting equity benchmark. They're not value focused, they're not growth focused, but they come in that core satellite approach as the core, hence the name Prescient Core Equity. So we want these portfolios to be building block portfolios, targeting a specific beta with this upward drift or pickup in performance from portable alpha, but importantly, giving our clients the freedom to mix in with whatever particular style or flavor that they might wish. So if they have a very positive view on resources, for example, or a very positive view on offshore developed market equities, so they could take our Aussie index, Aussie fund, and have that blended in with a resource manager or a offshore manager, and get a complete equity portfolio that has this anchor towards the core, which is this product.
So I like that the core and satellite approach. I mean, I think if what we see in South Africa, certainly from an equity allocation perspective, there's a strong bias towards active and sort of fundamental bottom up stock selection. Yes. The point here is that you can allocate to a core component from a Prescient perspective, and exactly what you're getting, and those active managers work around that.
Correct. And if I may add there, I think the important thing is that together, so the sum of the parts is bigger than some of the. If you combine it with the other managers, you get a more better risk adjusted solution than if you simply put all your eggs into one of those specific managers.
It's a very important point around the risk management. Bastian, that also talks specifically, and I think we need to highlight this, around our pricing policy. I think certainly from a fees perspective, there's a lot of concentration or conversation going on in the industry, not only locally but globally, around the cost of fund management. And I think this process brings that to the fore, because what we can see here is that expensive fund management is certainly a trend, and we know from particular surveys that fund management businesses are under pressure from a cost perspective, and certainly what's being charged. And I think there's this sort of article that we're going to be writing soon around active share. So it does mean that the price point that you pay for your equity inclusion is important. Maybe if you can just talk about how our philosophy and then what we charge for this and what that actually means for the end consumer.
Yes, sure. I mean, starting with the end consumer, the easiest way to create outperformance is to bring down your costs. That's just a crude reality. And we can measure, and we always do it and show it to clients, that there's a straight correlation between outperformance and low fees. So it's a misconception to say, yeah, for a good active process, I'm willing to pay up. It just simply doesn't work like that. And we could take this analysis way further. We can even show that there's a straight correlation between risk taking and fees. So more risky funds generally tend to have higher fees, or other way around. If you have a high fee, you take more risk to make up for the high fee. And with that, it's just extremely important to keep the fees low. So our core equity strategy is priced at 30 basis points. TIC is just about 40 bips. So it's just very, very cheap, and it's crucial. And especially in the equity space, a lot of funds are actually expensive. So the importance of low cost really can't be overstated. And there's so many reasons for that. just the compounding of it. And we know just a percent a year is maybe not a lot, but over a longer period, saving a percent on fees becomes massive. And then obviously also linking it to the risk taking. Like again, if you underperform for an extended period because your fees are too high, which eventually will happen if your fees are too high, the fund manager is inclined to take more risk. So lots and lots of reasons why the importance of low fees really can't be overstated.
So just a related point then, if I may, is actually this concept of this is not passive. You're actually getting, I think, what is a very competitive fee in something that actually is active, because you've got the portable alpha component, you've got the index inclusion, you've got a low fee. I mean, this is all good stuff.
Exactly. No, I think the misconception with this type of product is that it is passive, and therefore when when people look at it, they're looking for a passive fee. But it is anything but passive, as mentioned in the webinar. There is quite a lot of active management that's happening in the background. So yes, the profile looks pretty smooth. It looks passive-like, but with outperformance. But it is important for our viewers to understand that there is a great deal of active management happening under the hood to provide that smooth passive-like profile. And because it is that smooth passive profile doesn't mean necessarily that it is a passive product and therefore should be priced at the passive pricing point. If anything, we're competing just as much with the passive guys as we are with the full-on active managers, and we're just better on fees. Like Basti said, if you're good on fees, then that's the easiest way to actually deliver or pass on that benefit to the end client.
And over time, it makes a big difference. As you said, you compound an additional charge over a year, and you do that over a number of years. There's a significant erosion of return as a consequence. So thanks for that. And then sort of maybe one more question, which is quite interesting around this index harmonization and how that impacts you. Maybe you want to make a comment on, for those that aren't aware of what harmonization is all about. It's not a musical, but relating to the index changes in South Africa. If you don't mind.
So I could maybe take a few steps back here. So in South Africa, similar, I guess, to other markets, there are various indices that you can use to sort of gauge what the market performance is like. Because of legacy issues, we've had broadly two main methodologies. So we've had the ALSI methodology, which is essentially just a weighted average, market cap weighted average of the shares available on the JSE, included at their global free float. And then we have the SWIX methodology, which simplistically was introduced to simply provide a sense for what is available to South African investors. And what has happened is that over time, you had specific companies that were weighted quite differently depending on what index they're in. And this created quite a bit of dispersion in the performance of the indices. So you could have a situation where the SWIX index, so just the SWIX beta, is much higher or lower than the ALSI beta. And then this created a problem for clients. What benchmark do I go with? We like this portable alpha process. We like this core equity strategy, but we still have to make a decision on which beta to go to. And then obviously the JSE did a consultation, and they realized that this is a big problem for investors, and they decided that with consultation with the broader industry, that it was time to move to one methodology. And the methodology that we implemented simplistically will be the SWIX methodology. So essentially, we'll now have one method to sort of calculate one index that we can then be measured against. And obviously it's variance. The methodology is the same, so there'll still be a capped and uncapped version. But essentially, we had these two different methodologies that created a bit of confusion, made people have to choose between a specific benchmark. Now we're going to have one benchmark and all its variance. And importantly, I think worth mentioning is that we have offered, the Prescient products basically on every single one of those indices, or the big indices that investors are
so post harmonization, we'll compress the number of offerings into the indices that are available and appropriate post this reduced choice, effectively.
Exactly.
Yeah, okay. Makes sense.
So we have the Aussie, we have the SWIX, we have the CAP SWIX, and essentially the Aussie methodology and the SWIX methodology will be one methodology. Makes no sense to keep running correct.
Apologies for that sound. Okay, so yeah, I don't see any more questions coming in, but then maybe one last one, which we did mention in the webinar, which is this point around local and offshore. So from an equity point of view, Prescient Equity, the team offers local and offshore. Can you just maybe talk a little bit more about your global equity solutions?
Yes. So quite topical, again, with the increased offshore allocation. So we run the exact same portable alpha strategy, just on the two most popular and biggest offshore indices, which is the MSCI Developed Market, MSCI World Developed Market Index, and then the MSCI World Emerging Market Index. And as I mentioned in the webinar, there is this other index that is also quite popular, the MSCI All Country Index. But what really that is simply a specific combination of the developed market and the emerging market. So with our two offerings, which is the developed market and the emerging market, you can effectively manufacture and have the All Country Index as well, with the underpin of this portable alpha strategy.
Fantastic, thank you. Folks, that's it. I haven't seen another question come in, so I'd like to just say to Seeiso and Bastian, thanks for your contribution. And of course, to all of you that have dialed in today, it's always good to have you on our webinars, and we look forward to seeing you again. Thank you very much for your time today.
Thank you.